All right, today we're tackling something that is genuinely historic. We're talking about Proclamation number 1360/2025. Now, this isn't just any old piece of legislation. This is the law that's set to crack open Ethiopia's banking sector, which, you have to remember, is one of the last major closed economies on the planet. This is a huge deal, and it's going to completely reshape the country's financial landscape.
Okay, so let's get right into the document itself. This isn't just a minor update or a fresh coat of paint. Nope, this is a fundamental overhaul, really designed from the ground up to build a modern, competitive, and robust financial system for the future.
So, to really get our heads around this thing, we've broken it down into 5 key parts. We're going to start with the why. Why is this happening now? Then we'll get to the exciting part, how foreign banks can actually get in. After that, we'll check out the new rulebook for how things will operate, look at the safeguards for the system, and finally, what happens if a bank actually fails.
So first things first, let's get right to the heart of it. Why this massive change, and why now? Well, the answer is written right into the law itself.
The proclamation's own preamble really says it all. The main goal here? To pump some serious competition and efficiency into the banking system. The core belief is that bringing in foreign capital and, just as importantly, foreign expertise is going to be the rocket fuel for Ethiopia's long-term economic growth. All right, now, for the section I know everyone's been waiting for. How exactly does this new law let foreign banks come in and set up shop in Ethiopia?
So, the government isn't just flinging the doors wide open and hoping for the best. Not at all. The law lays out some very specific, very clear pathways for entry. So what are the options on the table?
Well, according to Article 10, foreign banks get a few different choices. They can go all in and build a brand new subsidiary from scratch, they could open a smaller branch office, or they could just dip their toes in with a simple representative office for things like marketing. And then there's the really big one. They can buy shares in an Ethiopian bank that already exists.
Now, there's a really important term you need to know. Strategic investor. See, the law isn't just looking for anyone with cash. It's specifically targeting established, big-name foreign banks, the ones with a good reputation, who can bring real value and know-how. And the National Bank of Ethiopia, they're going to be the gatekeeper, deciding who makes the cut.
But there are rules to make sure no single foreign company gets too much control. The law is crystal clear on this. It puts a cap on any single strategic investor's ownership stake at a maximum of 40%.
And then there's a second, even more critical limit. The total number of shares held by all foreign investors in one bank put together cannot go over 49%. This is the key. This structure guarantees that every single bank will still be majority owned by Ethiopians.
This proclamation is about so much more than just letting foreign banks in. It's really a top-to-bottom modernization of the banking rulebook for everybody, designed to create a system that's not just stable, but also encourages new ideas and innovation.
So, getting a banking license, it's not just a simple rubber stamp. As Article 4 lays out, it's a pretty tough 4-step process. First you apply, then the national bank goes through everything with a fine-tooth comb. You have to publicly declare what you're doing, and only then, if everything is perfect, does the bank get its license.
And check this out. This is something really forward-thinking. Article 89 introduces what's called a regulatory sandbox. Basically, it's a safe, controlled bubble where banks can test out new fintech ideas, like a new payment app or some cool digital service with real customers, but without putting the whole financial system at risk. It's a genius way to encourage innovation, but responsibly.
Okay, so you've got all these new players, all these new products. How does the law make sure the people in charge are actually trustworthy? Well, it all boils down to one thing: strong corporate governance. The law gets incredibly specific about who can even get a seat on a bank's board. Article 17 demands things you'd expect, right? Honesty, integrity, competence. But Article 18 is where it gets really interesting, because it lays out what you can't do. For example, you are absolutely barred from being a director if you were involved in a bank that failed. And you can't be a director at 2 different financial institutions. These rules are all about preventing conflicts of interest and making sure people are held accountable.
And what if directors don't play by the rules? Well, this law has some serious teeth. Article 20 gives the National Bank the explicit power to suspend or even remove a director for all kinds of things, from breaking the law to doing something that hurts the bank or the economy as a whole.
And that brings us to our final and really critical section. What happens if, even with all these rules, a bank gets into deep trouble?
Well, the proclamation sets up a very clear, very orderly process for dealing with bank failures.
So if a bank is teetering on the edge of collapse, the national bank can swoop in and appoint what's called an official administrator. This person basically takes total control of the bank, kicks out the old board and management, and their job is to protect the bank's assets and try to steer the ship back to safety.
Now, in any bank failure, there's one question on everyone's mind: who gets paid first? Article 62 creates a strict pecking order, and I want you to notice who is dead last on this list: the shareholders. And who is way up near the top? The depositors. That structure is absolutely intentional. It's designed to protect ordinary, everyday customers and keep people's faith in the system strong.
So when you step back and look at the whole thing, Proclamation 1360 is so much more than just a little tweak to the rules. It is a comprehensive blueprint for a totally new kind of banking sector, one that's open to the entire world, but is also carefully regulated, modern, and built to last.
So, the legal framework is officially in place, the welcome mat has been laid out. But the ultimate question, the billion-dollar question, is still out there. Is this new rulebook going to be enough to convince the world's top banks to come and invest? And will their arrival really trigger the kind of economic transformation Ethiopia is hoping for? I guess only time will tell.